Welcome to today's explainer. We're jumping right into a really fascinating and honestly kind of sobering look at what's actually happening in the 2026 labor market. Okay, let's dive into this. Is your salary being siphoned by an algorithm? It's a pretty provocative question, right? Usually when we talk about the threat of artificial intelligence, the conversation just stops at outright job loss. We immediately picture a robot or a piece of software simply taking over someone's desk, which leads us straight to the math behind this quote from the analysis. The downward pressure on wages for the jobs that remain creates a labor glut. Let's break down what this actually means in the real world. When AI displaces workers, those people don't just magically disappear, right? They re-enter the job market. This creates what the analysis calls a labor glut, meaning suddenly you've got a massive oversupply of available workers, all competing for fewer and fewer remaining positions. It's just basic supply and demand taking over. When there are way more workers than jobs, your bargaining power absolutely plummets. Corporations don't have to offer competitive raises or higher starting salaries because, well, there's a long line of displaced folks out there willing to do the work for less. Turns out, algorithms don't ask for dental benefits, and that puts immense pressure on all of us. This is the hidden tax. Your wages stagnate or even drop, even if you never actually lose your job. Let's move to section 2 and see how this builds. Unmasking the efficiency tax and looking beyond corporate restructuring. Now, what's really interesting about this slide is how the source completely redefines a super common business practice. They call this phenomenon the efficiency tax. We're neutrally reporting their analysis here, which states that this is a hidden penalty where algorithms replace paychecks. But the why is the crucial part. The analysis suggests this isn't just about a company trying to pad its profit margins. Instead, it describes this as a larger mechanism to service massive national debt. The argument is that what corporations publicly spin as routine restructuring is actually a massive systemic shift. Human paychecks are literally being swapped out for software to generate the crazy high efficiencies required in a heavily indebted macroeconomic environment. In the result of this efficiency tax, it's a relentless negative feedback loop for labor. Automation and AI aren't operating in totally separate silos anymore, they are merging. And as they merge, they create this cycle that traps everyday workers. Think about it. An algorithm gets smarter, a job gets cut, the labor pool floods, wages drop, and then the pressure to automate further just increases. The analysis makes it super clear that this negative cycle is completely blind to your job title. Whether you wear a hard hat or a suit, it really doesn't matter. Which takes us right into section 3, no sector is safe, looking at the broad impact across industries. Because if you were sitting there thinking, well, my specific industry is totally immune to this, the data across these different sectors is staggering. Just look at these spikes. We are seeing a 143% spike in manufacturing layoffs. But even wilder than that, transportation layoffs have absolutely skyrocketed by an astronomical 872%. This perfectly illustrates the argument that algorithms aren't picky. Whether we're talking about white-collar data analysis, blue-collar manufacturing, or the incredibly complex logistics of moving goods across the country, AI and automation are systematically finding and replacing human inefficiencies across the absolute entire board. Okay, so how do we handle this? Section 4, the hard asset fortress, a financial survival strategy. So the crucial point is, if the labor market is becoming this massive negative feedback loop, how do you actually protect yourself and your family? CPA Brian lays out 3 very specific steps to build your financial fortress and basically force the math back in your favor. Step 1, stop being the buyer of last resort. Basically, avoid getting sucked into those consumer cycles that just drain your wealth. Step 2, aggressively pivot to owning hard assets. And step 3, push for a $100,000 net worth explosion. According to the analysis, crossing that specific threshold of accumulated wealth is more vital than ever before if you want to insulate yourself from those wage pressures we just broke down. Let's actually focus on step 2 for a second, because it really is the anchor of this entire strategy. What exactly is a hard asset in this context? Well, the definition provided here is incredibly clear. It's wealth that an algorithm cannot print or replace. As the value of human labor gets digitally diluted by AI, the source strongly argues that you have to transfer your wealth into tangible things. And here's the bottom line reality. If a computer program can generate it, code it, or print it, it is susceptible to the efficiency tax, period. Hard assets, on the other hand, provide a solid physical boundary that software simply cannot cross. Which brings us to our final thought for today. We started out by asking if your salary was being siphoned, but based on everything we've unpacked in this explainer, from that massive spike in AI layoffs to the resulting labor glut, to the extreme downward pressure on your bargaining power. The real question you have to ask yourself right now is this: is your wealth insulated from the efficiency tax? If your financial future relies entirely on a paycheck that an algorithm is actively learning to replace, well, it might just be time to start building your fortress. Thanks so much for unpacking this critical analysis with me today.